This simple approach to market structure helped me to make over $44,000 in prop firm payouts in the last 3 months alone, and you could do this too even if you trade a full-time job. Now if we jump into the charts, I'm going to show you a very simple, straightforward and repeatable tick list which I have up on the screen here, so you can pause, you can write this down, take a screenshot and add it to your chart as well and go and do some testing. But basically what we're going to be doing is identifying daily time frame highs and lows to identify first of all what a trending market is, because if we're not in a trending market, this is not going to work, right? So that's number one. Find a higher time frame, ideally daily, a trending market. Next, we want to identify support and resistance levels. So if we're in a bullish market, like we will be in most of these US dollar-based indices, we are mainly going to be looking at support levels because we're going to be looking at buying. So every time price mitigates a support level, we're going to be looking for extra confluences, which I'll run through before we look at opportunities to trade. One of them is daily liquidity, and I'll run through how to spot daily liquidity. And for those of you that are quite new to trading, if you didn't know what that means, it's basically in a bullish market where price runs into a low, a previous low, to collect liquidity because there's orders unfulfilled at that point to then be a catalyst to drive the next high. So those are the areas of high probability where we want to be getting involved in opportunities. We then will look at our second time frame, which is the 4 hour. Now the 4 hour for me is my key driver. That's where I spend most of my time, and I do trade on lower time frames as well, but for this video, for the purpose of keeping it super simple, and for those with a very busy lifestyle that perhaps work a 9 to 5, maybe you're really busy in the day, you want to trade from your phone, or you're very limited on time in the day because of other commitments, but you still want to trade, I'd recommend sticking to a higher time frame like the 4 hour. So we'll be looking at the same thing, 4 hour liquidity, especially in and around support levels on the daily time frame. And then for entry is going to be simply a 4 hour retrace candle. So it's going to be a bullish candle in an up market or a bearish close in a bear market. And then for take profits, we're going to be looking at daily structure highs and lows, or we can trail the stop loss below the 4 hour lows in a trending market, because again, that's what we're looking at. So we are expecting price to reach a high and carry on driving through. So without further ado, I'll keep that on the screen up there to the left, and we'll start off by looking at gold. Now I do have a watch list of around 4 or 5 assets. I actually stopped trading Forex about a year ago because the volatility had really dried up on Forex, and also you'll find a more range-bound choppy market. Whereas if you move over to commodities and indices, you will have much more volatility and a trending market. So already it doesn't matter what your strategy is, your results are going to be better from that change. Before I carry on with the video, I just wanted to let you know that if you are serious about making trading your full-time business and actually wanted to quit the 9 to 5 job and make trading a full-time thing, I do actually have a mentorship where you work one-on-one with me for 6 weeks minimum, and that's helped students like these go from inconsistent to profitable in a 6 to 8 week period, funded and taking regular payouts from trading like these. So if that's for you, click on the first link in the description below and apply to work with me. If that's not for you and you're just here for watching the video, I'll get back to it right away. So we're going to be looking at gold first of all, and just as a snapshot, this is current price where we're at now. We're not going to use bar replay or anything like that. We're just going to spot what this daily time frame is, what it is in terms of highs and lows. We're going to work our way through this tick list and work your way through it with me as well. So quite clearly we have a high, we have a low. We're looking at swing points as well, so not everything in between. We have a high, we have a low, we have another high, a low, and these are all higher highs and higher lows, wouldn't you agree, right? Until we get to around December, Christmas, just gone, 2024, right? And this is where we're at now. So what we've done is within a few seconds is we've identified we are in a bullish trending market on the daily time frame on gold. And This is not going to change for quite some time because every candle takes a whole day to print. And these swing highs and lows are typically going to take anywhere between a few weeks to a few months to change. So from a higher time frame perspective, you can see that how easy this is now with a full-time job or with a secondary business or a hectic lifestyle, that you can still trade because you don't need to spend hours and hours doing your morning analysis, because you know, well, if I'm trading gold tomorrow, we're still most likely bullish on the daily time frame, so I'm only going to be looking for buys. Of course, you can drop down to the lower time frame, and I will take sales off a 15-minute time frame, but you don't need to do that. Next up is identifying support or resistance levels. Well, if we're in a bullish market, in my opinion, on a daily, you only need to look at support levels. So it's basically lows which are formed after price has broken a structural high. And we're waiting for price to come and retest that. And then when it breaks, we mark a break of structure. And then we have the same thing. Now, price isn't always going to come back to that level. You can see that price never retests this level. But if it did, we'd be interested in that zone. So I'll leave it on there anyway. So we have a break of structure here. Price pushes higher. We do get this bearish candle with this wick inside of here. So we'd be looking at that area, and you can see it comes and retests it quite a few times actually. Consolidates for a while, but it's still bullish. So what's going to pay off? Buys from that supply zone. Inside of this range, you may as well just leave it alone, or you'd be looking at something else on your watch list. A break of structure to the upside. We have this down candle here. Mitigates, respects it because we're in a bullish market. Another break of structure. And we're just going to very quickly mark out these. There aren't many on a daily time frame, so this is not going to take long, this exercise. Now we can print this one. Doesn't quite come to get it yet. We have this one here. Again, doesn't quite get it, but then is respected now, as you can see. So I'll just stretch that across. And we'll finish off with that last structural high point, because we're at this point, all-time highs has not yet been reached, right? Now we've got, obviously this is in hindsight, right? But all you're basically doing, if we are seeing price take off and we're up here, all we're waiting for price to do is to come back into this support level or this support level for our next requirement. If it's not done that, we're not interested. And on TradingView, for those who didn't know, you can right click and set an alert, right? So for example, if I was waiting for price to come back into this level now, I can right click here, set an alert, and we can put gold support, create that. And you can go around your daily business and not have to even open TradingView app on your phone or your desktop until you get that notification that price has come back into that area, right? So next on the list is daily liquidity. Now I did briefly touch on what daily liquidity is. I'll remind you again. So this is a bullish market, so we're only looking for sell side liquidity. Sell side liquidity is liquidity below a low. Buy side liquidity is liquidity resting above a high. We're not so interested in that because we're only looking for buys. So if we start down here, we can see there's a low in the center of this consolidation. I will mark as daily liquidity. In fact, I'll zoom in. So when price taps into not only this support zone, it's also increased its probability and is making it a zone that we're going to be really interested in trading because it's taken a daily low inside of that. If it's taking liquidity away from that support zone, I'm not as interested. It's lower probability. We have this area which has not been mitigated. Price didn't come back, it just took off. We had extra volatility in there. But when we have the next consolidation, we have a daily low, which you can clearly see on this time frame, which is inside support, which is mitigated. So this is an area again of interest, of high probability. We're looking for buys. Actually comes back again after taking the high, it comes back, and you can see this low is taken. I know the liquidity isn't in this support zone, and marking out support and resistance is not an exact science, just rough guide, but the actual liquidity taken by that daily candle, the same candle that took liquidity, also mitigated supply. So this is also an area we're interested in. Price goes and takes daily liquidity again in here. So again, there's 3 opportunities inside that consolidation, and you can see we're only buying in this area of interest. We're not looking at buying in here or here or in here, you know, that's in the middle of the range. The middle of the consolidation is the dangerous place, right? What do we have here? We have a low inside support. So another high probability area. And there can be periods where we don't get that as often, right? We don't then get one for quite some time. We get one here, but price doesn't mitigate anything. You can, by the way, go off daily liquidity without supply. Again, it's the same as supply without daily liquidity. It's valid, it's just lower probability. So I'll mark that on there anyway, but the higher probability is this one, and you can see why I say support and resistance zones are not an exact science, because price pierces all the way through. That doesn't matter, that's actually higher probability because it takes this daily low and it reacts instantly. You could basically wait for this daily candle to close. You can see a wick, and we're going to drop down to the 4-hour time frame next for entries, and it will make more sense on there. We're not entering off the daily time frame because we want slightly more risk to reward, and we don't want to be waiting weeks or months for a trade. You're probably typically going to be looking at maybe 1 or 2 trades per month off a 4-hour time frame following this very systematic, simple approach. Now I take maybe 1 or 2 trades a week per asset. Typically, sometimes it's more, sometimes it's less, but I do trade off the 15-minute. And again, if you're looking at multiple assets on your watch list and you're no longer taking 1 trade a month, you're now taking 1 trade a week, right? So everyone's different, personal preference, but we're just keeping it super simple for the nature of this guide. Right, so we now have 1, 2, 3, 4, 5, 6 areas of high probability based on daily sweeps. The next on the list is going down to the 4-hour, and we're doing the same. And this is where it's going to give us even more opportunity, because remember, the daily liquidity zones inside support is higher probability. It's not the only zones we're looking at entry. We can take them off 4-hour liquidity sweeps as well. Right, so we actually have this whole area of support. As you can see, the previous range before we broke daily structure, which is here. And if we zoom in, this is 4-hour time frame, we can see price broke this structural high to the left, came back inside of support, and you can see it printed a low on the 4-hour time frame. It swept the low. I say a sweep because of the nature of price. The bottom 50% of that candle is a wick, and the top half closed bullish. Not every strategy is 100% strike rate. In fact, no strategy is 100% strike rate. This is not going to win every single time. But if you can pick higher probability areas, you are much more likely, especially in a trending market, to win more than you lose. And even if you win and lose equal amounts, 50-50 strike rate, you should have more than a 1-to-1 risk to reward ratio. Now, you could set a fixed 2-to-1 and be in and out of that in a day. You could set a 3-to-1 fixed to reward ratio and be out of this within a few days. For the purpose of this video, we're going to be targeting the next daily structure because we've identified we're in a bullish trend on the daily. So we expect, if we are well priced, being well priced in buys entries in support zone after liquidity on the 4-hour or daily, we should stay in the trade until price reaches the next structural high point. And you can see with this, that reaches, even with quite a substantial stop loss size, you're looking to the left to target, to protect your stop loss below these lows. I say target, kind of target these lows with your stop loss. You could go even wider. If you really wanted to, you could go much wider and actually cover below support, and you could still get a 3-to-1 out of that position. But for the purpose of this video, let's keep it underneath a low at least. So we've got some protection, but not going overboard. We're not going too long, and we're definitely not choking the trade. Price then pushes away. and it doesn't reach take profit, but it doesn't come back to stop loss either. It just comes back and retests the support zone. Now this one is barely a retest, right? You'd expect price to pull deeper than this, and also back on a daily time frame, this is creating a daily low, which we've denoted right here. So when price comes back into this area, which we've circled as a high probability area because of that daily liquidity inside support, we have a retrace candle here on the 4 hour. We could even have our stop loss in exactly the same place as our original entry because the profit target has not been reached. And by the way, you're going to need a swing account on this because you'll be holding through news, which you won't be able to do on typical prop firm trading accounts. I do have some links below to a reputable prop firm that have swing trading accounts, so you can hold through all news, which is normally restricted by the likes of FTMO and most other leading prop firms, and a prop firm that I use myself. So you can hold through these, which is not a problem. So the first position, you're looking anywhere between 5 and 6 to 1. Second position, 3, 4 to 1. Or TP on both if you're fixed 2 to 1s, 3 to 1s, no problem at all. And you can see I'm not interested in anything inside of this range, this consolidation. I'm only interested in daily or 4 hour liquidity inside support in this bullish market. Next one, as we can see, never came back to retest, right? So that's absolutely fine. There is some opportunity here on both the 4 hour and on the 15 minute, but for the purpose of this video, I'm gonna skip across and keep focusing on these daily support levels and 4 hour liquidity. Now we have 3 high probability areas here on the daily. As we can see inside this support, broke structure way down here to the left. We know we're still in a trending market, and we can see inside of here, we have a 4 hour bullish candle. This time we can have our stops below the support level. Again, look to the left for some protection and profits at the previous high. Good 5 to 1 on this one very easily. Next one, again, daily liquidity, the same exact setup over and over again. And I'm looking at data here of around 10-month period on gold. So you can go back over 2024 and look at this same period. This is not 1 week or 1 month I'm looking at. This is almost an entire year. Structural high we have up here now. And if you missed that one, you have a re-entry, which is almost identical. Let's put the stop and the TP in the same place, and both of those are reached again. Now that's 3 positions within the space of 2 months. You'd make profit within about 2.5 months, and you're looking at 5, 6, 7, 8, 12, 13%. So you're looking at easily 6 or 7% per month, trading higher time frame, barely even looking at a chart, hardly doing anything, waiting for your daily alerts on TradingView to hit inside this support zone, not interested in selling at all. Super simple. That's just one asset, just gold alone, right? Now we have the next area of support after it broke this structural high. Again, very systematic, same thing over and over again. We wait for the first 4 hour bullish candle to close, and we have our stops below these lows here. Structural point here, 4 to 1, nearly a 5 to 1 on this. Now, do we have one more opportunity in here? Yes, again, we have some 4 hour liquidity inside of here. I've hardly even focused on 4 hour to be honest, but we do have a 4 hour low that's mitigated inside of this. Again, it only just pierces into it, so I'll probably leave that one and wait for it to come back and retest, which it does. It takes another 4 hour low inside of here, and I'd be more inclined to take this next one. So we wait for that 4 hour retrace candle, the bullish candle, which is this one here. You can either take a buy stop above the actual candle, above the wick, or market execute on a closure. Won't really make that much of a difference. Stop loss below a low, but let's give it a bit more breathing space as well. We don't need to choke the trade whatsoever. And in this one, because we can't actually even get a 2 to 1 before a structural high, so that in my trading rules, my personal trading rules, that makes it a lower probability trade. Unless I decide that I am going to anticipate price to continue, and this is where the trade management style of trailing your stop loss below 4 hour lows comes into play. I'd much prefer, and my students know this in evolution markets, that I'd much prefer to trade at these areas targeting a high, because the RR, the risk to reward, is greater, and we have a set target, we have something solid to aim towards. If you're trading all-time high territory, there's nothing to the left to target. You don't know if it's going to wick the high, come right back for a break even or a loss. So I'd rather stay out of those. However, what we can do is we can move our stops to break even once price breaks the high. So we're risk off, so stops would be down here. And then for every time that a 4-hour high is broken, you trail your stop. So below this 4-hour low here, and you'd wait. Then when it breaks the next structural point, we trail our stop below the next 4-hour low. Let's go a bit higher. So we have one more. So if price is around here, what are we doing with our position? We are doing nothing but simply trailing our stop, which takes seconds, and then price comes back, takes us out for a massive 5-6 to 1 with a substantially large stop loss. So if we just go back for a quick summary on this, we'll have a look at date ranges, number of trades as well. So between December last year and November this year, you're looking almost a complete year. We have 1, 2, 3, 4, 5, 6, 7 trades. So less than 1 trade a month, but this is just very quickly going over most of the daily positions. There's only 2 4-hour positions in here. There's a lot more than that if you look closely and if I actually took my time. Of course, this is over a 15-minute period covering 10, 11 months. In a real life market, we have a whole day to be able to be patient and wait and concentrate, right? Only one of them we've trailed the stop loss. The rest of them we've targeted structural highs. Of course, they all went much further. So your profit taking is going to differ person to person, but we're looking 6, 7, 8, 9, 10. We had about 15 in there, so 25, 30. You're looking about 40% across 10-month period on one asset. And this works across all different indices and assets. You've got the SP 500, which works the same as you can see. We have US 30, which works the same again, and you can even trade the German DAX, more European indices markets, which works very similar. So once you've built a watch list of 3, 4, 5 assets, you're now trading at least 2 to 3 positions per month just off daily support, daily liquidity, trends, and the occasional 4-hour sweep in there as well. Now, if you've got this far in the video, first of all, well done. Congratulations for committing yourself to watching this full video. And I want you to comment below and just let me know for feedback what you actually took away from this video. What's the main thing that you found beneficial? And the thing that is probably going to help you in your trading, I'd really love to know, and that helps me get feedback for future videos. I do plan on posting every week through 2025. So the more feedback I get from you guys, my watchers, my viewers, and I appreciate you, the more content I can put out there for free and to hopefully help you on your journey to being as profitable as possible. And those that are looking at working closely with me, taking their trade further, if you're not interested in 1 trade, 2 trades a month, but you'd rather take 2 to 4 trades a week and looking at a lower time frame, I don't tend to go much lower than a 15-minute time frame. If it's helped, I do have a link below with an application to apply to work with me over a 6-week period, one-on-one, to really nail down your specific trading results and get you quickly from where you are now to consistent and funded, or even trading live funds in our in-house fund. Thanks for watching, and I will see you on the next one.